And welcome back. We're still very much stuck in January and the resolutions about being better with money are being tested to the limit already. But is there one major way to save that you've been overlooking?
Well, if you're a homeowner, switching mortgages could be for you. And financial advisor Paul Merriman is here with all of the details.
Morning,
Very
Paul.
good morning to you, Paul.
Good morning to you both.
Thank you for joining us. I think as a nation, we're getting better at switching generally, whether it's our mortgage or our various utilities, aren't we?
Yeah, I think the utilities more. I think people think it's a bit easy. I think people have a fear about the mortgage part. So I think it was only 20% switch maybe in 19, less last year, 2019, less last year. So the mortgage is the big one. You know, it's the biggest financial commitment you're going to ever probably make. And you need to make sure you're on the lower interest rate. But I think what happens, people get emotionally attached to the house, you know, when they're going for the mortgage, and they just take any mortgage. You know, so there's a bit of advice here for first-time buyers and for people that need to switch when we talk about interest rates and the money that you can save.
But also, most people won't find themselves in a situation where they have various offers. I mean, you're delighted to get the mortgage, aren't you? You jump through hoops to get there.
Yeah, you do. But in fairness, like if you look at how many different prices are on the marketplace today, and if you're a first-time buyer going, even a switcher, there's 66 different interest rates. There's only 10 banks in this country, and there's 66 different options. And that's why, in my opinion, you need a financial planner. You need someone to sit down with you going through it. You know, we have a mortgage department in askpaul. We're out the door with people coming to us looking for advice. But it's more about the financial planning part as well as the mortgage.
Okay, and when you're given that advice, Paul, why do you tell people to switch?
Purely the money. You know, you should be controlling your money, not the banks. So I'll give you an example. If you have a situation where you have a €300,000 mortgage, okay, and it's at 3%, you're going to be paying back the bank an interest alone €155,000. So if you're at 300,000, you're paying back 455,000 to the bank. If you switch to say 2.5%, you're going to save yourself over 29,000 in interest over the term of the mortgage, or about 950 quid a year. And that's €950 better off in your pocket than the banks. But what we come in as financial planners then is, rather than just keeping that money, or maybe some people back into the mortgage, for argument's sake, if you put it into your pension plan, it could grow to maybe with interest, with kind of tax relief on your pension plan and growing with interest. It could maybe you make it up to 125 grand in your name rather than the bank's name. So you're going there between 30 grand and 125,000 in your name rather than the bank's. So it's purely down to you owning your own money and making, I suppose, really good decisions and simple decisions.
And keeping that interest rate as low as possible.
Keeping the interest rate as low as possible.
So who's in a position to switch their mortgage? Not everyone is.
No, not everybody. So obviously if you're on the employer wage subsidy scheme or you're on the PUP, you're not going to be in a situation. The banks won't take you on in that situation. But you know, there's still around 200 million people working. There's a lot more people that can than can't, luckily enough. But yeah, they're the big ones. And maybe if you're self-employed, you've been affected by the pandemic. But if you are, you can simply, once the pandemic is over, COVID-19, and you're back and working not on these payments, it will be simply you'll be able to go back for your switcher in 6 months' time.
Okie doke, we can see your 5 rules for switching there, one of which is number 3. Make sure you review your mortgage protection policy. How does that relate to switching?
So the mortgage protection policy is attached to your mortgage. It's life cover in case anything happens. So it's very important to review that because your mortgage should be coming down obviously over the years as well. And mortgage protection policies changed drastically in this country over the last number of years to make sure you have the best policy really. I think that's probably a really, really good tip for people when they're changing, not to forget about their mortgage protection. But just to give you another example, actually, if you look at, like, say for example, Permanent TSB a few years ago had a rate of 3.1%, and Ulster Bank are at 2.3% now. So a lot of people are coming off that fixed rate, maybe Permanent TSB. They should be looking at that 2.3%, 100% with Ulster Bank, or even KBC are in that bracket as well. And then we've Advent Money came into the marketplace last year, bringing rates under 2%. So there's just so many offers out there. You need to speak to someone that's qualified and need to spend time on this. And I wouldn't just be going directly into a bank. That's probably the worst thing you can do is go directly into the bank because you're only getting their rates.
Yeah, you're not.
Like I said, there's over 66
around.
rates in the marketplace.
How does it affect you? This might sound like a dumb question. Whether you be variable or on a fixed?
Very good question. Well, you should be on a fixed, in my opinion. The variable rates are very high. Again, if you look at one of the banks out there, they're charging 4.5% for their variable rate. So that's almost double what that, going back to that Ulster Bank example, at 2.3%. So, you know, banks want you to be secure in what you're paying in the first few years. So that's why fixed rates are lower. Where if you go back 10, 15 years ago, you would have had fixed rates being higher than variable rates. But you shouldn't be on a variable rate. You know, you should be on a fixed rate for at least 1 or 2 years. But like I said, there's just so much money to be saved and put in your own back pocket, and it's not that difficult to switch.
It's starting the process, isn't it?
Yeah, and I think people think it's a lot of hassle, but you know, when you buy your first house or even if you move home, you end up in a situation where you have the auctioneers to deal with, you're trying to find a house, you're trying to bid, and so the whole process is just stressful. But when you take all this away, you're not moving home. You're just moving your mortgage. So yes, you've deployed, but it's a lot less stressful than people think it is. And if you're saving 30 grand or, you know, investing it to make maybe 125 grand, it's worth a few hours.
So if you're in negative equity, do you still have the option of switching?
No, if you're in negative equity, you can switch. And also, sorry, if you're on a tracker rate, obviously you wouldn't be switching because tracker rates are kind of sacred and they're really, really, really low. So there are the two exceptions to the rule, I suppose. And if you're on the PUP or the employee wage subsidy scheme, but they hopefully will be gone in the next 6 months out of the country, and hopefully people in that situation will be able to borrow.
Do you know if you sometimes ring up your electricity supplier, your mobile phone supplier, and you tell them you want to leave, or your television,
they'll change your rate,
your internet provider. They tend to work with you a bit. Is there any suggestion of that?
Well, there's a lot of people out there that might be on a higher interest rate, and they could switch simply by ringing their bank because they're loan to value. They've more equity in the house. They might have bought it a good few years ago. But again, you're looking at that bank's rates only. So I would start by maybe ringing your bank, getting the lowest rate they'll do, and then coming to someone like ourselves or going anywhere and just try and find out what the rates are around the whole marketplace. It's so impractical for somebody to be going through 66 different rates. And as well, Aidan, so some of the banks take into consideration if you're switching as well, maybe overtime, they take in commissions differently. So they all have different lending criteria as well. So I think that's important. And then last you say this, you know, people can get exemptions. So you can only borrow 3.5 times your salary. But if you get an exemption, say 2 years ago, you don't need the exemption. When you're switching, the banks don't have to follow the Central Bank of Ireland, those strict rules. So you won't have to go through the same kind of rigmarole again. So it's even easier to switch in that case. So
pick up the phone, shop around, but start with your current provider because, as you say, it's a good point. They could actually change your rate before you shop around at all.
They definitely could, but they're probably not going to. It depends on what the bank is. Again, it depends on who you're banking with. They might give you a cheaper rate than you're on, but another bank might give you a completely cheap rate, and they might give you cashback. There's loads of cashback offers out there as well to incentivise people to switch, which is really important.
Okay, food for thought. Thanks, Paul.
Thanks, guys.